Hi everyone, inflation worries are taking a toll on tech stocks, but we could well see a post-data relief from tomorrow. Also, speaking of tech stocks, I asked Amazon or Alibaba and you answered. So there's one major worry that keeps investors up at night at the moment, and that's inflation. Rising worries of seeing an overshoot in inflation is what drives tech stocks lower at the beginning of this week. So Nasdaq closed Monday's session some 2.5% lower, while the S&P 500 fell some 1%, and today's Chinese data didn't help soothing investors' nerves. So producer price inflation in China jumped to 6.8% year on year in April. Well, they jumped more than 20% in Norway. But the consumer price inflation, on the other hand, in China surprisingly eased below 1% during the same month, meaning that for now, the rising factory gate prices haven't translated into higher and product inflation, but it will, and that's the problem. I think the suspense on the consumer price inflation and is killing investors. You just want it to just happen to see a reasonable rise in consumer prices in line with expectations, or ideally softer, so that the wait doesn't seem long and consuming, that wait for the CPI data. Now, it's less consuming for those who are at the right place, obviously. In this respect, commodity prices continue their race to the stars, so do the mining companies' share prices in London. A couple of weeks earlier, I have given a couple of my favorite mining stock names that trade in London, remember, including BHP Billiton, Anglo American, and Glencore, and they are doing well right now, and they should continue outperforming their tech peers, even with a stronger British pound, as investors are now looking for efficient hedges against rising inflation and rising inflation expectations, and there is no better place than commodities to do so. Of course, it's very obvious, it's the chicken and egg story. The fact that the commodity prices have gone so high is, of course, contributing to inflation expectations and inflation itself, and commodity prices, which are at a decade high levels right now, could be scary as an entry point for an average investor. But mining share prices have lagged during the pandemic months, and they actually still remain interesting, even if they are catching up with the delay quite fast. So price pullbacks in mining stocks could be good entry opportunities for investors looking to hedge against inflation. The sooner you're in, the better. Now, what will happen to the tech stocks? I believe nothing dramatic still. We have a couple of tense hours in front of us before the US inflation data due Wednesday. Then we shall start seeing some relief, unless we see an impressive jump in the US consumer prices, which I doubt, as we don't see a dramatic rise elsewhere just yet. We shouldn't see a dramatic rise in the US inflation data either. So it's crucial now that you understand that inflation does matter, but the Fed's policy matters much more. Inflation is important because the Federal Reserve has an inflation target, and if inflation goes above that target level, they will need to tighten their financial conditions, the monetary policy, sooner rather than later. And because the Fed's ultra supportive monetary policy is the main driver of the equity prices right now, the market needs this liquidity, the Fed liquidity, continue flowing in. Otherwise, with the overstretched valuations that we see at the moment, a downside correction is, in theory, inevitable. And we see the most stretched valuations in the tech stocks, obviously, because there is a good deal of their future growth potential that is priced in their prices right now, meaning that their valuations tend to diverge from their fundamentals much more than the value names, which at least have some concrete something to base their valuations on to offer to their investors. So that's why your favorite growth stocks, your favorite tech stocks are on a very slippery ground, and the value names are less before the inflation data. Now, okay, inflation is important, but it is not the number one driver of the Fed policy. That's the good thing. It is the number two driver right now. The number one driver of the Fed policy for now is the US jobs market. And as long as inflation remains in line with the Fed's target of an average of 2%, then the inflation number per se is not an issue. And that's the trick. Inflation has just started picking up momentum in the US and elsewhere. So we still have some way way to go before it threatens the Fed's average of 2% target. And more importantly, even if inflation hits that 3.6% level expected by analysts this week, the Fed will continue playing down the durability of an eventual overshoot in inflation. So we still have time before starting worrying about a material and a durable rise in the US consumer price levels and its eventual impact on the Federal Reserve's policy. And that's probably what will be saving the tech stocks this week after the data. For now, the most important for you is obviously to survive the pre and post-inflation volatility. I would still recommend having a stop loss strategy in place, but not too close to the current levels, as we may see some more price volatility into the figures. But I believe that many investors will be grateful for Friday's morose jobs data in the US once the inflation barrier is behind us. Now, speaking of these tech stocks, I asked on Twitter, would you rather buy Amazon or Alibaba shares? And you guys answered. Before we dive into this subject, please do not hesitate to participate in my polls on Twitter. Send out your remarks, your reactions, and your questions about what's spoken and what's unspoken. What you want me to talk about, I'm always very much interested to have your opinion because market is you. Now, roughly 2/3 of those who participated to my survey yesterday said that they would rather buy Amazon shares than Alibaba shares. Obviously, the sample is by far not big enough to drive any global conclusions about the subject, and buying Alibaba or Amazon shares is not mutually exclusive. But interestingly, the result is pretty much what I would expect to see. Amazon, which trades near the most expensive ever levels, is still more appetizing for investors than its Chinese peer Alibaba, which trades at a sizable discount nowadays. Now, of course, the government cracked down on big Chinese techs recently, and the US-China tensions have a lot to do with the loss of appetite in Alibaba shares, but the Chinese antitrust risk is now over, so that's a good thing. Alibaba will pay a big fine, yes, but less than what investors feared, and US-China tensions remain, yes, that's a pending risk, but we would hardly see Chinese stocks being halted on US exchanges. Of course, things could change fast, but to me, that remains a tail risk. So, why Alibaba has such hard time attracting the tech investors nowadays with its net income margins consistently about 20%, driven by massive economies of scale in China and across the globe. Alibaba's profitability is in the upper tier of your favorite American tech stocks. The company's core commerce sales surged near 40% last year. The active users in China reached 780 million people. That was up 22 million over the past year. And there is more room for Alibaba to grow in China and abroad. It has at least as much growth potential left than its Western peers, if not more. And it already holds the 2/3 of the Chinese online retail business, and there is a third more to go. That's exactly how Jack Ma would put it. And more importantly, when you have such a huge consumer basis, any new feature or new service that you launch just gets through, gains momentum, and has a good chance to work. So this Thursday will be an important test for Alibaba investors. It will be an opportunity to amaze and bring back investors for the company with strong results and give a proof that the giant is not dead just yet. Well, I'm exaggerating when I say just dead yet, but you get me, right? According to Nasdaq.com, the Alibaba shares are trading at an all-time high low valuation. So compare with your FANG stocks, which trade near all-time high valuations. That's quite interesting. What would take for investors to get back to Alibaba? That's the thing. From a price perspective, Alibaba's share price just died below its 1-month uptrending channel base yesterday, meaning that the price retreat could actually continue toward the $200 mark, another 10%, but we may be approaching a buy zone in Alibaba shares. This is all for today. I'm İpek Özkardeşkaya, and thank you for joining me. I hope this episode of Market Talk has been helpful and insightful to you. Please do not hesitate to follow us on Twitter and on LinkedIn for regular market updates, polls, and reactions, and subscribe to our YouTube channel for daily market comments. I meet you again tomorrow, and until then, Good day trading.